Hi, everyone. Today we're going to do a real quick review of Units 3 and 4. We'll look at the financial sector and government stabilization policies. Now, this isn't meant to reteach you every single thing that you need to know, but these are the biggest ideas, the most important concepts from the past two units that you definitely need to know to do well on the test. So let's get started. So first, we looked at consumption. So obviously, if there's an increase in wealth, there'll be an increase in consumption, which means aggregate demand will increase. If there's a decrease in wealth for any reason, there'll be a decrease in consumption and aggregate demand will shift to the left. Changes in future disposable income will affect consumption as well. So, spending typically goes up when people expect the economy to go up, right? If you expect a pay raise, you're going to be more likely to spend money. Aggregate demand will shift to the right. And spending typically will go down if people expect a bad economy. If you expect that you might lose your job, you're going to be less likely to spend money, more likely to save it, and uh, consumption will go down and it will decrease aggregate demand. Another concept that we talked about in the first lesson of Unit 3 was the savings investment identity. So, where do banks get the money to lend to businesses to do investment? Well, from people's savings account, right? That's banks have money in their vaults because people deposited money there. So more savings means more investment. When more people put money into their savings account, interest rates go down, and that means that it's cheaper for businesses to borrow money and investment will rise. And why is that important? Well, we know that when investment rises, it's a great thing for the economy. So financial markets are very important in economics because they bring together borrowers and savers. They bring together the people that have the money with the businesses that want to borrow the money to grow the economy, to spend money to build things that will create jobs. So if a business borrows money and invests and builds new factories, aggregate demand will shift to the right first. But once those factories get going, aggregate supply will shift to the right because they're going to now be more productive. And once that's possible, long run aggregate supply will shift to the right. And that's the best possible case for the economy. That will create the new standard for the economy. And that's real economic growth. And it all starts in the financial sector because businesses typically pay for investment with loans. All right. Bond prices and interest rates. We talked about bond prices and interest rates. It's kind of counterintuitive, but when bond prices go down, the price of bonds goes up. And when bond prices go up, the price of bonds goes down. Now, here's what I mean. If the government issues new bonds at high interest rates, the older bonds that are already out in the market that have lower interest rates are going to be less valuable. People would rather have the new ones. And so when interest rates go up, the price for existing bonds goes down because people want the new ones. If the government issues new savings bonds at lower interest rates, the old ones that are already out there at higher interest rates are going to be more valuable, and the price for those existing bonds will go up. Here's the point. When interest rates go up on new bonds, the bond price for existing bonds goes down. If interest rates go down on new bonds, the bond price for the existing bonds that are out there in the economy will go up. All right. Then we talked about money. There's two types of money. There's commodity money. That's money that has value as money, but also it has some intrinsic value. It's got a value besides the fact that it can be used as money. And there's fiat money. Fiat money has no other purpose than to serve as money. It has no other value besides the fact that you can trade it to buy things. Now, in order for something to be classified as money, it's got to meet three characteristics. Number one, it has to be a medium of exchange. It's got to be easy to use and to buy goods and services, and it's got to be widely accepted. Second factor that will make something money, it's got to be a unit of account. It's got to be able to measure the value of goods and services. It's got to be divisible and able to say this is worth that amount. And third, a store of value. Money can't go bad. Like milk couldn't be money because milk only lasts a couple of weeks before it rots. So money's got to last for a long time. It's got to be a store of value. All right, so classifying money. Well, first thing, liquidity means how easy you can turn an asset into cash and how easy you can use this thing to exchange to buy stuff. So M1 currency has the highest liquidity. So cash obviously is very easy to spend. So that's M1 currency. Checkable bank deposits, checking accounts are super easy to use at the store. You can write a check or use a debit card and you can get the things that you want. And traveler's checks as well are all considered M1 currency. They're the most liquid currency out there. M2 is considered near money. Now, M2, this is the part that people always forget. Don't forget, M2 includes all of M1 plus the following things: savings deposits, small time deposits like CDs, certificates of deposit, and money market funds. Now, they're not super difficult to cash out and use as money, but they do require an extra step. For example, a savings account. You can't buy things at the store from your savings account. First thing you got to do is you got to transfer it into your checking account, and then you can buy something at the store. So these are near money. They are a little bit more difficult to use. They're a little less liquid than M1 currency, but M2 includes M1 and these other three types of money that we just talked about. All right. The next thing we learned about was fractional reserve banking. So when you put money into a bank and the bank holds that money in reserves, how much of that money is actually kept in the vault? Well, only a fraction. That's called fractional reserve banking. They will take your deposit and then use that money to lend it out to make a profit. So to understand fractional reserve banking, there's some important vocabulary words you need to know. First, demand deposits, money that's put into a commercial bank. When you put your paycheck into your bank, that's a demand deposit. You can always go back to the bank and demand your money back. So that's why we call it demand deposits, when people put money into the bank. Reserves, money that's held by the bank, money that the bank keeps in their vaults is called reserves. The reserve ratio is the proportion of money that the bank keeps in reserves compared to how much people have deposited into the bank, right? So if somebody deposits $1,000 into a bank and the bank only keeps $100 in reserves, the reserve ratio is 10%. They're only actually keeping 10% in the vault and the rest is lent out or used for some other purpose. The required reserve ratio is the percent of demand deposits that the Federal Reserve forces banks to keep in their vaults. We don't want banks to lend out all of your deposits because they need to have some cash on hand if you show up to get your money back. So the Federal Reserve tells banks, hey, listen, you have to hold on to this percentage of people's deposits, leave it in your vaults, and don't touch it unless your customer comes back and asks for their money back. Excess reserves. Excess reserves are the reserves that banks have above the minimum required amount. So if the required reserves are 10%, but a bank has 15% reserve ratio, that means they have 5% excess reserves. And the thing that's important about excess reserves is that's money that the bank can play with. That's money that the bank can lend out and make a profit off of. And the last thing that we talked about was a balance sheet. A balance sheet is kind of accounting more than it is economics, but it's a record of all the bank's assets and liabilities. It's also known as a T account because of the shape right here. This looks kind of like a T. You might see this on the test or on the AP exam. So, from a bank's perspective, this is an example of a T account. From a bank's perspective, a loan is an asset, right? Because that's going to get paid back plus interest. Any money that they keep in reserves is an asset because they could lend it out. And treasury bills are an asset that a bank can have because that will earn interest. So all of these, from the bank's perspective, are assets. Liabilities are, from a bank's perspective, deposits, right? So if people deposit $200 million into this bank, it's a liability to the bank because people can come back and get that money back whenever they want. And net worth, you might see that sometimes on a T account. Net worth or owner's equity is just money that the bank owes to its customers. So you have assets on the left, liabilities on the right. But here's the important thing: if you add up these numbers on both sides, they have to balance out. That's why they call it a balance sheet, right? So banks have all of this money that people put into their bank, and here's all of the things they're doing with that money. So assets on the left, liabilities on the right. That's a T count. You need to be able to balance those out if you see those on a question or on a test. All right. When banks lend out money, it creates new money, right? Fractional reserve banking will create new money in the economy. That's the most important reason why we talk about fractional reserve banking, because loan making has a huge effect on the overall economy because it creates new money. It can increase the money supply. So, how much does loan making increase the money supply? Well, it depends on the money multiplier. So, this is a super important formula that you're definitely going to need to know for the test. The money multiplier that you'll use to figure out how much of a loan increased or how much a loan increased the money supply is 1 over the reserve ratio. So just figure out that calculation. 1 over whatever the reserve ratio is will give you a number, and then take the loan and multiply it by that multiplier, and that will tell you how much new money got created in the economy. All right, then we learned about the loanable funds market. It's a simple supply and demand graph. Supply to the sky, demand to the dirt. Excuse me. Real interest rates are here on the y-axis, and the quantity of loans is here on the x-axis. Now, when interest rates are high, people don't want to borrow that much in loans. But when interest rates fall, people want to borrow more money because it's cheaper to borrow money. When interest rates are high, lenders want to lend a bunch of money, right? And people want to put more money into the bank to earn that interest. So the supply is upward sloping. And when interest rates fall, people say, forget it, give me my money back. I'm going to spend it. And so when interest rates are low, the supply of loans is low. And where they intersect, that's equilibrium. That's going to be the interest rate for loans in the market. All right. Now, the curves can shift in the loanable funds market. Um, Demand shifters change and perceive business opportunities. If businesses have a positive outlook about the future, they're going to be more likely to take out loans. Loans will increase. Changes in government borrowing. If the government borrows money, they borrow money from the private sector, that increases the demand for loans and raises interest rates. That's a concept called crowding out. When the government deficit spends, that will raise interest rates for you and me and businesses. The supply curves can shift too. Changes in private savings behavior. When people put more money into their bank, that increases the supply of loans. Changes in public savings, it's counterintuitive, but when the government saves money, it decreases the supply of loans. And the reason why is because the U.S. government doesn't keep their money in Bank of America or Wells Fargo. The U.S. The U.S. government keeps their money in Federal Reserve vaults where they don't get lent out, and they just sit there until they're needed. So when you put money into your bank, that money gets lent out, and that increases the supply of loans. When the government saves its money, it just puts it in the basement and it doesn't get touched. Changes in foreign investment. If more foreigners are putting their money into U.S. banks, that will increase the supply of loans. And last one is changes in expected profitability for lenders. Obviously, if lenders feel like they're going to make more profit in the future, they're going to be more likely to lend out to make loans. All right. Next is the money market. So first thing you need to know is the demand for money. So you might think the demand for money is infinite, but it's not that concept. It's not the demand for wealth. It's the demand for cash money, right? It's the demand for M1 or M2 currency. So there's two reasons why people need cash. Number one is the transaction demand for money. Obviously, you need cash to buy stuff. And number two is asset demand for money. Some people would rather have the cash because they might feel that it's less risky than keeping it in the bank. They might feel like they're better off keeping their cash under their mattress than losing that money in the stock market, for example. But there's an opportunity cost for holding onto your money. Remember, if you hold on to your cash, you're losing the opportunity to earn interest on that money. So that's a factor to consider in the money market. So the demand curve for money is downward sloping, but the money demand curve can shift. So if prices go up, people obviously need more cash to buy stuff. That will increase the demand for money. Changes in income. If people are making more money, they're going to want to buy more stuff, and that will increase the demand for cash money. And changes in technology. As check cards and debit cards became more common, the demand for cash money decreased because it was so easy to use plastic instead. All right. So if you put the money demand curve here and you add the money supply curve here, you get the money market graph. So the Federal Reserve controls the money supply. The Federal Reserve can increase. or decrease the money supply. And where the money supply curve and the money demand curve intersect gives you the interest rate or the federal funds rate. Now, the Fed can move the money supply curve to the left or right. Federal Reserve, the National Bank of the US, doesn't control the money demand curve. That's up to us, we the people. But the government can control the money supply. So if the Federal Reserve moves the money supply curve to the left or to the right, that will impact interest rates and will have an effect on the economy as a whole, and that's called monetary policy. So remember, there's three places the economy can be. We can be in a recessionary gap where GDP is down. We can be at full employment, which is where we want to be, and we can be in an inflationary gap. So we want to be at full employment. If we're in a recessionary gap or an inflationary gap, the government needs to fix it. And so that's what we learned about in Unit 4, stabilization policies. So the government has two main toolboxes that they have to fix the economy. There's monetary policy that's controlled by the Federal Reserve. They can use that to stabilize the economy, or they can use fiscal policy, and that's up to Congress, and that's all about taxing and spending. So let's get into those. Monetary policy first. The Federal Reserve, if they want to speed up the economy, if they want to step on the gas, here's what they do. If the Federal Reserve increases the money supply, that decreases interest rates. When interest rates are lower, businesses are going to be more likely to borrow money and invest. And when businesses invest, that creates jobs and increases aggregate demand, and that will grow the economy. That's expansionary monetary policy. If we're in an inflationary gap and prices are getting too high, the Federal Reserve is going to want to decrease the money supply. And if you look here, we go from this point to that point, this equilibrium point to that equilibrium point. Interest rates go up. So decrease the money supply, interest rates rise. That means that businesses are going to be less likely to borrow money. Investment will go down, and that will decrease aggregate demand. That's the way the Federal Reserve can step on the brakes using monetary policy. So, how do they increase or decrease the money supply? Well, there are three ways to increase the money supply using monetary policy. Number one, you can decrease the reserve requirement. You can tell banks, "Hey, don't hold on to so much cash in your vaults. Lend it out. That will grow the economy. That money will get lent and spent, and it will grow the fire." Number two, you can decrease the discount rate. The Federal Reserve can offer banks a discount when they borrow money and charge them a lower interest rate. If banks borrow money from the Federal Reserve, they're going to lend that to their customers, and that money is going to get spent, and that will grow the economy. And the most important one is open market operations. The government can buy securities. Remember, the trick for this is buy makes the economy bigger. If the government buys securities, they have to pay people for them. So the government's taking treasury bills back, T bonds, securities, savings bonds back from the people, putting cash in their hand, and the people are going to go to the store and spend that money, and the economy will grow. So if expansionary policy grows the economy, contractionary policy shrinks the economy. So let's do the opposite. If you want to contract the economy or slow the economy down, you would increase the reserve requirement. Tell banks they have to hold on to more cash. That means there's less money available to lend. The fire slows down. Increase the discount rate, charge banks, the Federal Reserve can charge banks a higher interest rate, which means they're going to be less likely to borrow money. And if they're not borrowing money, they're not lending as much money, and that slows the economy down. And remember, buy makes the economy big, sell makes the economy small. If the government sells securities, right, they're putting T bills into the economy and they're taking cash out of the economy, and that will slow down the economy. Because remember, you can't spend a savings bond at the store, right? So if you buy a savings bond, that's less cash that you have available to spend at the store. That money doesn't get into the fire and the economy slows down. That's monetary policy. So those interest rates that we were talking about, those are called the federal funds rate. It's kind of confusing. The federal funds rate is the interest rate that banks charge each other. Now, the Federal Reserve can't just tell banks what price to charge or what interest rate to charge. It's a free country. Banks can do whatever they want. But the Federal Reserve has interest in setting that interest rate. So what they do is they set a target and they move the money supply curve to the right or to the left to make the interest rate that they're hoping for a reality in order to control the money supply and therefore grow the economy or slow the economy down. So the federal funds rate is the rate that banks charge each other. But the reason why we call it the federal funds rate is because the Federal Reserve has a big impact on what that rate is. All right, so that was monetary policy. The other way the government can manage the economy is through fiscal policy. If we want to step on the gas and grow the economy, if we're in a recession, there's three ways we can use fiscal policy to do that. Number one, increasing government spending will increase aggregate demand and grow the economy. Number two, cutting taxes will mean that there's more money in people's paycheck for them to spend. That money gets spent, aggregate demand will grow, and we can increase transfer payments. If we increase welfare payments to people or Social Security, that means more money for people that need it, and they will spend that money, and the economy will grow. If the economy is growing too fast, we want to slow the economy down. We'll use contractionary policy. That's stepping on the brakes. Just do the opposite. If the government cuts government spending, the economy will slow down. If the government raises taxes, the economy will slow down because people will have less money in their paycheck. And if they decrease transfer payments, if they make cuts to welfare, that means that people on welfare or Social Security will have less money available to spend. And all of those will slow the economy down. All right, now remember, when people get new money, there are two things they can do with it. Either they can spend it or they can save it. The marginal propensity to consume is how much of a new dollar you're likely to spend, and the marginal propensity to save is how much of that new dollar you're likely to save. So the marginal propensity to consume plus the marginal propensity to save has to equal one, because those are the only two things you can do with money. So these numbers are important. You can also say that the marginal propensity to consume is 1 minus the marginal propensity to save. So why do we need to know those numbers? Well, you need those numbers to calculate the multiplier. So if the government increases spending, how much is GDP going to change? Well, remember, one person's spending is another person's income. So the change in total GDP is going to be the change in spending times the multiplier. Well, how do you get the spending multiplier? The spending multiplier is 1 over the marginal propensity to save. So if government increases spending by 5 billion, well, the question will give you the marginal propensity to save or the marginal propensity to consume. Figure out what the spending multiplier is, and then take the 5 billion times it by the multiplier, and that will tell you how much the economy will actually grow, because you got to take into account that spending multiplier. The other multiplier is the tax multiplier. Now, remember, if you cut somebody's taxes, some of that money is going to get spent, sure, but some of that money is going to get saved. Spending, by definition, gets spent, but tax cuts, by definition, not necessarily all of it's going to get spent. Some of it might be saved. So there's a different formula for calculating the tax multiplier. The tax multiplier is the marginal propensity to consume over the marginal propensity to save, or the marginal propensity to consume over 1 minus the marginal propensity to consume. Either way, if you want to know how the economy is going to change from a tax cut, you take the change in taxes or transfers. Remember, we use the tax multiplier for transfer payments as well. Take the initial change in taxes, figure out what the multiplier is, and then multiply those two numbers together, and that will tell you how much GDP is going to be. And don't forget, there's a cool trick. Whatever the spending multiplier is, the tax multiplier is always 1 less than the spending multiplier. So if the spending multiplier is 4, we know that the tax multiplier is going to be 3, just as an example. All right, now remember, there's 5 problems with fiscal policy. Number 1, if we use fiscal policy to get out of a recession, that adds to our budget deficit, and that will add ultimately to our national debt. If we overspend, it's going to add to our national debt, and that money's going to have to get paid off eventually. Number 2, problems of timing. Congress is notoriously inefficient, and sometimes they don't react in time to really deal with the recession, and sometimes they come up with a policy, and by the time the policy is enacted, it's too late and it wasn't enough, or the economy already fixed itself and now it's not an appropriate policy. Number 3 is politically motivated policies. When the economy is good, the smart thing for politicians to do is to raise taxes and cut spending and save money for a rainy day, but that's not politically popular. And so politically motivated policies are a problem with fiscal policy, because the right move economically isn't always what's politically popular, and politicians want to be popular and get elected. And oftentimes, politicians will do the wrong thing to get reelected, even if it's not the economically smart thing to do. Another one is the crowding out effect. If the government is borrowing all this money in order to deficit spend to get out of a recession, well, that's going to raise interest rates, and that's going to crowd out private investments. So if the government is deficit spending and borrowing a lot of money, interest rates are going to go up, and that's going to be harder for businesses to borrow money or for regular people to borrow money either. The other one is the net export effect. So if the government increases aggregate demand through fiscal policy. A negative aspect of that is that when aggregate demand increases, that means that our price levels go up. If US price levels go up, foreigners are going to be less likely to want to buy our products, and that's going to decrease our exports, which is going to decrease aggregate demand. So the government increased aggregate demand, but that caused prices to rise, and then so foreigners bought less of our products, and aggregate demand went right back to where it was potentially. So that's the net export effect. Makes fiscal policy not always as effective as we would hope to deal with a recession. All right. Then we talked about the alternative views on macroeconomic policy. Um, Adam Smith, the pure classical theory of capitalism is that prices and wages are very flexible. So recessions are no big deal. If aggregate demand decreases, well, that's bad for people, but don't worry, prices are going to drop. So everything's going to work itself out just fine. The government doesn't need to get involved because when we're in a recession, prices will drop. And yeah, you're making less money, but prices are lower. So everything's fine. Aggregate demand is totally vertical. And GDP is not going to be affected by the recession in the long run. Well, Keynes came along after the Great Depression and said Adam Smith is right, but only when the economy is doing good. He argued that there are three ranges of the aggregate supply curve. There's a point, and he argued that prices and wages are much more sticky than Adam Smith argued. So he argued that the economy can get so bad that it can fall into this range where prices have hit rock bottom, wages have hit rock bottom, and if aggregate demand keeps getting worse, the only thing that's going to happen is GDP is going to continue to go down. And if you want to get out of the Keynesian range, the government's going to have to push aggregate demand to the right to get out of a really bad recession or a Great Depression. All right, now the very last thing. This is probably the most important slide of the whole thing. A lot of this class had to do with the multipliers. Don't forget the three multipliers that you need to know. First, the money multiplier. If the question is about banking and fractional reserve banking and T accounts, or if it's about monetary policy, use the money multiplier. Remember, the money multiplier is 1 over the reserve ratio. That's the money multiplier. If the question is about how much is the money supply going to grow if this loan gets made, well, take the loan, multiply it by this multiplier, which is this formula, 1 over the reserve ratio, and that gives you the answer. These other two, the spending multiplier and the tax multiplier, you use those for fiscal policy. So if the question is about government spending, you use the spending multiplier, which again is 1 over the marginal propensity to save, or 1 over 1 minus the marginal propensity to consume. So if government spending goes up by $5 billion, you need to take into account this multiplier, and here's the formula. It'll give you a number, multiply the spending by that number, and that will tell you how much the economy actually grew. And the other one is the tax multiplier. You use the tax multiplier for taxes and for transfer payments. So if the government cuts taxes by a certain amount, how much is the economy going to grow? Well, you take the tax cut and then you use the tax multiplier, the marginal propensity to consume over the marginal propensity to save. That will give you a number. Multiply the tax cut by that number, and that'll tell you how much the economy is going to grow. If you don't have the marginal propensity to save, don't worry. You can use the marginal propensity to consume over 1 minus the marginal propensity to consume, and it'll give you the same number, and there you go. And don't forget, there's a trick. If you know what the spending multiplier is, the tax multiplier is always going to be 1 less than the spending multiplier. All right? Those are all the big ideas from units 3 and 4. Good luck, study hard, and I will see you in class.